Well, good afternoon, everyone, and welcome to our weekly webinar where we will talk about what we see happening in the global economy and in financial markets and how all of this impacts our decisions on the best courses of action for your portfolios. Thank you for taking the time out of your busy schedules to join us. We are recording this so that those who can't join us live can tune in when it is more convenient. I'm joined on the call by my partner and colleague, Paul Tepsich, the founder of HighRock, and also on the call is our financial planner, Bianca Tomlinson. We'll have a Q&A period at the end of the call, so if anyone has a question about portfolios or any other aspect of wealth management, we invite you to feel free to ask questions. As most of you know by now, but for the benefit of some of our newer listeners, HighRock was founded by Paul in 2010 to manage a series of closed-end funds for Scotiabank. We are registered with the Ontario Securities Commission, which is an agency of the province of Ontario. We recently initiated our private client division to try and take advantage of some of the synergies that come with the management of our funds. But in some of our conversations with clients and prospective clients, we often get lumped into the same category as brokers or financial advisors. And I cannot stress this enough, that we are not brokers or financial advisors. We are a portfolio management company who has a clear understanding of wealth management. Now most financial or investment advisors are not paid to manage your money. They're paid to gather assets and then find a mutual fund or other third-party manager to place your money with. In fact, many advisors place their clients' money at HighRock. This means that they are paying fees on top of fees. So in essence, our private client group is intended to try to take the middleman out of the equation and save our clients money. So we base our portfolio strategies on our clients' goals determined through a wealth forecast. The synergies and scale that we have with our fund management side of our business allow us to pass on cost savings to you, our clients. In a low return world, this can add significant value to portfolio growth over longer periods of time. Now, our responsibility to our clients is that your interests have to come before our own. We're held accountable to that level of fiduciary responsibility. And that cannot necessarily be said to be true for all investment advice or investment advisors who may be paid by a third party as a result of as a result have an inherent conflict of interest. And that's another important difference. So not only do we have to report to the Ontario Securities Commission on a regular basis, but we also have something that no one else offers, and that's an independent review committee that reports directly to our clients to ensure them that we're doing everything that we say we are doing, putting our clients' interests ahead of our own. My reason for joining Paul at HighRock was to be able to offer something different and better, not just to talk about it, but do it. And we have that formula in place now. Okay, so let's check in on our broad themes for 2015, and one of those themes has been to expect the unexpected. And so far this year, falling oil prices have had their impact on the Canadian economy, and they forced the Bank of Canada to cut the bank rate, and that was unexpected. Other central bankers have been using extraordinary measures that we also call quantitative easing to help reduce volatility and keep confidence in their respective economies alive. Global economic results for the first quarter of 2015 have showed some significant slowdowns. That was unexpected, especially in the U.S. And at the beginning of the year, this was, as I said, not expected. What is expected is that the U.S. will lead the global economic recovery in the second half of 2015, and that the U.S. Federal Reserve will start to normalize interest rates in September. The Bank of Canada has pinned the hopes of the Canadian economy on an improving U.S. economy in the second half of 2015, and recent consumer confidence numbers are beginning to show that Canadians are buying into this theory. Another one of our themes for this year has been the question, will we have deflation or inflation? Last week, on Friday, we had both the U.S. and Canadian inflation data released. Interestingly, the headline data continues to look rather deflationary. But this is all based on the impact of lower energy costs. If we look behind the impact of energy, there are some developments that we need to be taking note of. In the U.S., the core CPI, after the impact of food and energy inputs are taken out of the equation, that has been rising steadily. And if it continues, we'll soon move on to the U.S. Fed's 2% target. I'll talk a little bit more on the Fed's target in a moment, but being below target has given the Federal Reserve some breathing room in regard to the timing of the beginning of the normalization of interest rates. And as I mentioned before, those are expected to, the market's expecting to see that start to happen in September. Okay, so you may ask yourselves, well, what is the purpose of inflation data without taking into consideration food and energy? Because we all need to eat and we all drive, or most of us do. But the point is that these are temporary factors that because of their volatility in the short term, after a year or so, when those numbers are annualized, they'll bounce back and start to look excessively inflationary down the road. So in order to take this volatility out of the index, what happens is they factor out the more volatile components like energy, which was down by about 19.4% in the U.S. Last month. Interestingly enough, food prices were unchanged. Okay, so as I mentioned before, the Federal Reserve targets inflation at the rate of 2%. Now, the index that they use, which has not yet been announced for this month, we don't see that until June 1st, but the index that they use is the price index for personal consumption expenditures, the index they believe to be the most consistent over the longer run with their inflation mandate. So this index measures a basket of goods and services that is updated annually as opposed to the CPI, which measures a fixed basket. Semantics, but the Federal Reserve is watching this, so we believe that if they're watching it, we should pay close attention to what this index is doing. As I said, we'll have to wait till next week to see the latest round of data for this indicator. So we look at the CPI data to see if there's any clues for what we're going to get from this index. And as I said, we'll see you next week. Okay, so in Canada, it's pretty much the same story, except that the core rate, the one that the Bank of Canada focuses on, is actually above their 2% target. It's at 2.3%. So in essence, this means that a bond yielding less than 2.3% is providing a negative real return. So with 10-year Government of Canada bonds yielding 1.75%, the negative return, the negative real return on a 10-year Canada bond is about 55 basis points. So bond investors will not be content for very long if they perceive that they're going to get negative real returns. So this is something that's been obviously driving Canadian bond prices and yields over the last little while, and not just in Canada as well, on a global basis. And that, of course, leads us to the all-important bond markets, which, again, is another theme that we've been following in 2015. We have been watching as bond investors have been starting to try to look ahead, look forward beyond the current bond buying programs in Europe and Japan, and trying to assess when they expect inflation might start to reappear. This has been driving the selling of low-yielding bonds and pushing yields higher and prices down in the last month and a bit. But central banks continue to want to keep volatility low because high levels of volatility create uncertainty and erode confidence. And as I mentioned before, confidence is crucial to getting individuals and businesses to continue to participate in the economy. So central banks also have to be vigilant about future inflation as well, and they don't want inflation expectations to reappear and get out of hand the way they did back in the 1980s. So what have we seen lately? Well, just looking back at the Canadian situation, the 10-year Government of Canada bond. As you can see from this chart, we've seen a recent, as I said, over the last month and a bit, rise in yields, peaking just around 1.9% in yield. Over the last week or so, they've come back down to closer to 1 3/4. So that situation is starting to settle a little bit, and none of this, of course, can be taken alone. We've been talking about the global economy and the expectations for the U.S. Pulling the global economy along in the second half. And some of the recent economic data we've been keeping an eye on certainly has been on a global scale. We've been watching Germany, and most recently the German Business Confidence Index showed us that after a few months of gains in April, the German Business Confidence Index, IFO, stalled out, was unchanged. So we're keeping our eye on that. We know that 1 month does not necessarily signal a trend, so we take this data in its series. We've seen a positive trend since the beginning of the year, but we want to make sure that that continues, and of course, the central banks want to make sure that that continues as well. Japan, again, data have been a little better, but still, most of 2014 was a sideways year for the Japanese economy, and it started to turn up in a small way, but of course, hard to say exactly where that's going at this point in time. Looking at the Chinese economy, we know that it's been slowing and in danger of slipping below the official 7% growth target that the People's Bank of China and the government has targeted, and the People's Bank of China, the Chinese central bank, has been cutting interest rates, and recently the government has lowered some taxes on a number of imported goods in order to try to stir consumer demand. So again, we're monitoring our developments in China along the way here as well. And finally, of course, one of our themes has been, equity markets. And today we saw the S&P 500 down just a little more than 1%. And our theme, generally speaking, has been that we feel that equity prices are expensive, and this is the slide that I've been popping up the last few weeks. And last week, of course, Paul mentioned that there was another chart that he felt was even more representative of that theme. So I'm going to pop that chart up and then turn it over to Paul to just sort of give you a little rundown on what he's looking at here.
Thanks, Scott. This chart may look kind of confusing, but it really isn't. Is really similar to the price-earnings ratio that Scott had up on the previous slide. But as opposed to using price, we're using enterprise value, which you can see at the top of the middle of the screen is EV. And enterprise value, just quite simply, is the worth of that company, or in this case, the collective worth in aggregate of the S&P 500. The worth is really defined as stock market value, or similar to the price on a PE ratio. It's a stock market value plus the debt of the company or those companies in aggregate. And then EBITDA is quite simply cash flow or earnings. So again, similar to the earnings in the PE multiple. But what this does is strip out the number of shares outstanding in the stock market, collective number of shares. So it's a much more pure valuation metric that we use, and we actually use a screening tool to look for companies that are trading cheaper than you can see. The S&P 500 is now trading around 12.25 times enterprise value to EBITDA versus the average, which was around 10 times over the last 10 years. And I would just tell you anecdotally that a lot of the companies we look at are trading in the 5 to 8 multiple times range, not 12. So to us, 12 looks very expensive, and 10 is not even all that cheap. I mean, if we owned a company that was taken out at 12 times, we'd be very, very happy. So we see that as expensive or very rich. And the only other thing to add here, Scott, is the other reason why we look at this, besides the fact that it strips out the share count, is because this is what companies look at when they actually do mergers or acquisitions. When a company goes to acquire a competitor, for instance, they value that company on an EV, or enterprise value to EBITDA basis. They don't value it on a price to earnings basis. So this is, to us, a very important and a pure valuation metric for the stock market and the individual stocks.
Okay, thanks for that, Paul. That's great. So now let's move into what we've been doing with our client portfolio models, and let's start with fixed income. I think we talked about this last week, but a couple of weeks ago, we decided to take advantage of some of the weakness that we've been seeing, some of the increases in yield. We wanted to take the opportunity to add some 10-year Government of Canada bonds at those better levels, and that was something that has turned out to be very positive for our client portfolios. We haven't added to any since then. We wanted to look for potentially better entry points if they do happen, but at this point, the purchases that we made are actually looking pretty good. Did you want to add to that at all?
Yeah, I wish we bought more, but we didn't quite get the high, but we got pretty close, or the high yield, or the low price. We did get sort of close, but we bought a small piece. But I guess our overall theme when we're investing is to leg into positions, not buy an entire position. So we've done that with some of our individual stocks as well. We haven't always gone out and bought a full position, so we do look for better entry points here into the fixed income space. And I guess, Scott, the only other thing to add would be for people not to get too spooked about owning, say, a 10-year bond. We bought them around 1.82%. And, as per your inflation slide, we don't want people to get too concerned about that, because government bonds will trade as an asset class themselves, and there are all kinds of players in the market that need them, specifically financial institutions that are regulated that can't hold anything else other than government bonds. And I think, as people may decipher from our comments, we're not 100% sure where inflation is right now, where it's going to go, but I personally think it's going lower, not higher. Anyway, we did leg into some bonds, and we'll do more when the time comes.
Well, another reason to own government bonds, of course, is that when there is a movement of capital into more quality holdings, when volatility levels rise, when stock markets, if they are overvalued, start to sell off, you'll see, as we did today, with equity markets down close to 1% or about 1%, you do see a movement into government bonds, and again, they're defensive, as you said. Okay, moving on, let's talk a little bit about our global equity. Not a lot going on there either. As we've said, we think equity prices are a little high. We're not interested in putting new money to work. We have, over the last few weeks, been switching from higher cost ETFs into lower cost ETFs of similar nature in our model. So, but we also have allowed our client portfolios to be a little bit more cash heavy in order to be a bit more cautious and defensive, holding off in making new purchases and allowing our client portfolios just to be a little bit more defensive for the time being, based on our themes for equity markets. And finally, of course, we have the Canadian growth part of the portfolio. Again, Paul's been busy looking for value there, and I know he just mentioned how he looks for value, but I thought if he has an update for us, we just throw it over to him again.
Well, no change in the valuation metrics on this front at all. Just we do own a couple stocks, but we're trying to be the same as we are in the global or core equity model. We're trying to be patient here, and if we have more days like today, Scott, we might have more luck finding value, but I think there's a ways to go. So no real additions to the portfolio at this stage.
Okay, excellent. So in a nutshell, again, we look at today as an interesting day in the markets. We'll obviously watch to see how things develop, whether or not buying support does come into the equity market, or whether buyers are going to wait for better values. And if there are fewer buyers in the market, prices could start to come down a little bit too. So we're also heading into the summer months, so we do expect that volumes will start to lighten up a little bit, and when that happens, there is the potential for a little bit more volatility. And again, if there's volatility that goes in our favor, we definitely will look for opportunities to put money to work for our clients. Okay, well, that's basically it for today's discussion. Again, as I mentioned at the beginning, if anyone has a question they'd like to jump in here, this is the time. And please feel free to ask it of myself, of Paul, or if it's a wealth management question or a planning question, Bianca's on the line too, and she'd more than be happy to take your questions.
Hey Scott, it's Paul. Can I actually ask a question?
You fire away.
So I think you just referred to it in your conclusion or summary, but maybe to take it one step further. You were talking a bit about volatility may pick up, it's summer months coming. What, if any, and are you a believer in sell in May and go away, or seasonality factors? I know some people really track those sort of things, seasonality factors, but there is the typical old adage, sell in May and go away, and I know that has worked in past years, but not every year. But what are your thoughts on that?
Well, it's interesting because I actually focused one of my blogs on that factor right at the end of April. And I actually looked back at the last couple of years, and I didn't go any further than that. The evidence is that selling in May doesn't necessarily provide you with a better opportunity down the road. Last year was if you're able to catch the bottom in October, you might have picked up a little bit of, but that was a very difficult bottom to catch. It didn't last very long, and it bounced very quickly back up. So last year really wasn't a good play. The year before, it definitely was not. But it's definitely something we'll revisit maybe next week on the call in more detail. But my theory is that, yeah, maybe historically there has been some years where more buying in October, September has been beneficial, but not necessarily selling in May. So I'll just sort of leave it at that.
Okay, thanks.
Yeah. Any other questions from our listening audience? All right. Well, we'll leave it there for today. If you do have questions that you didn't want to feel comfortable bringing up on the call, please absolutely feel free to email us. We're always happy to have communications with our clients, or even if you're listening for the first time and you have a question, that'd be great. We'd love to hear from you. But other than that, that's it for another week. So thanks again for taking the time to tune in. I hope you all have a great week and a wonderful weekend, and we'll be back with another webinar next Tuesday. I'll be from a remote location, but still focused on our client portfolios and able to be with you on Tuesday. So look forward to that, and take care.